Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to look at IFRS 5, non-current assets held for sale and discontinued operations. Now, this standard is in two parts. The first part is non-current assets held for sale, and the second part is discontinued operations. And so we are going to look at the standards, the scope of the standard in general. We'll look at the exclusions, and then we'll take the first part, the non-current asset held for sale, which is the main part of the standard. We'll look at it into detail, and then afterwards I'll talk about the discontinued operations as well. So it is in two parts, but we combine them and we say non-current asset held for sale and discontinued operations. Okay. Now, what is the scope of this standard? The scope of this standard is to prescribe the accounting treatment for assets held for sale and how to disclose discontinued operations in the financial statement. Now, what do we mean by assets held for sale? I'll be coming there to define that. But before that, let us look at the exclusions from the standard. You know, with the International Financial Reporting Standards, most of the standards have exclusions, okay? And so IFRS 5 deals with non-current assets held for sale and discontinued operations. But what are the non-current assets that cannot be classified under this standard? That is what we are going to look at. Okay, so after we have looked at the exclusions from IFRS 5, then I'm going to teach you the definition of held for sale, and then we are going to look at the criteria for classifying an asset as held for sale, and then we can take an example and look at that. So let us first of all look at exclusions from IFRS 5. Now, the measurement provisions of this standard does not apply to the following assets that I'm going to list. And please take note. These kind of questions come in a tricky way, such that you are expected to be able to advise the organization in question, okay? Now, they can trick you by including any of this and tell you to treat it as held for sale. And then what you need to tell the examiner is that these are excluded from the measurement provisions of this standard. So in other words, what I mean by exclusions is that these assets are excluded from the measurement provisions of IFRS 5. And the first one is deferred tax assets. So in other words, you cannot measure deferred tax assets and classify them as held for sale or discontinued operation. That's the meaning. So deferred tax assets are excluded from IFRS 5. That is the meaning. Deferred tax assets are treated by IAS 12, income tax. Okay? And then the next one that is excluded from IFRS 5 are assets arising from employee benefits. Assets arising from employee benefits, which is also treated by IAS 19. Okay, so this is by IAS 12. So these are within the scope of other standards, and therefore these kind of assets, even though we are talking about non-current assets, this standard is a standard that relates to non-current assets. However, we are looking at these assets that are excluded from the measurement provisions of IFRS 5. And we are saying the first one is deferred tax assets. We do not measure deferred tax assets as assets held for sale. And then assets arising from employee benefits. And then also financial assets within the scope of IAS 39. We know that IAS 39 is one of the standards that talks about financial instruments, okay, just as IAS 32 and others. So financial assets that are within the scope of IAS 39 do not fall under IFRS 5. And then also, the next one is non-current assets that are measured according to the fair value model in IAS 40, investment properties. So non-current assets. So in other words, we can say that investment properties that are measured by the fair value model of IAS 40. Non-current assets that are measured by the fair value model in IAS 40. And we all know that IAS 40 talks about investment property. So we do not also bring that into the measurement provisions of IFRS 5. You know that most of the time, before I begin to take you through solving questions of this kind of standards, I always want to look at the exclusions first. So in other words, I'm looking at what it is not before I come to what it is, so that it will help you to understand better. So these are exclusions. So let us look at them very carefully. When we are done with the exclusions, we come to the inclusions. What is IFRS 5? So please, the next assets that we should look at, contractual rights. Contractual rights. Contractual rights under insurance contracts. As defined by IFRS 4, insurance contracts. So these contractual rights will also be excluded from the measurement provisions of IFRS 5. And then finally, we can look at biological assets. Biological assets within the scope of IAS 41. Biological assets measured at fair value less cost to sell. Under IAS 41, agriculture. Okay, so these assets are excluded from the scope of measurement provisions stipulated in IFRS 5, non-current asset held for sale and discontinued operations. So please listen. When you are solving any question involving IFRS 5 and examiner demands that you advise the company, you advise the company on how to classify any of these assets as to whether it should be classified as held for sale or not. First of all, you should understand that all these are excluded from the measurement provisions of IFRS 5. And if they are included in the question, they are just there to trick you. And so you need to ignore them, and then you tell the examiner that according to the standard, these assets have been excluded from the measurement provisions of IFRS 5. And that is what I want you to understand first. So having been able to understand these exclusions, let us go on to the definition of held for sale, and then let us look at a disposal group and what are the conditions that will help us to classify any other asset that is not listed here as held for sale. So in other words, apart from these non-current assets here, we can classify some other assets as held for sale. And what is the meaning of held for sale? That is what we are going to look at. Okay. All right, so let us try and define these two terms. The first term I want us to look at is held for sale. What is the meaning of held for sale when we say an asset is held for sale? Because that is the core of this standard, non-current asset held for sale. What is the meaning of held for sale? When we say an asset or a non-current asset is held for sale, it means that the carrying amount of that asset will be recovered mainly through selling it rather than usage. In other words, if you have a carrying amount of an asset in your book, you can only recover that carrying amount when you sell it, not through using it. That is the meaning. Then we say that asset is held for sale. So when the carrying amount of an asset will be recovered mainly through selling rather than using it, then we call that asset as held for sale. We classify that asset. So when an asset is classified as held for sale, that's the meaning. And then what you should also understand is something that we call disposal group. Disposal group. Now, a disposal group is a group of assets and liabilities, possibly sometimes. It could be a group of assets or assets and liabilities that an entity wants to dispose of in one single transaction. So in other words, you have a furniture, you have motor van, you have land, you have building, you have some payables, and you combine all of them to sell in one single transaction to one person. Then that particular group of assets that you are about to sell together as one. We call them a disposal group. Okay, so now held for sale is when we know that the carrying amount of an asset will be recovered through selling rather than using it. And a disposal group is when you combine one or more assets and some liabilities in some cases to sell together in one single transaction. That is what you should understand. Now, the key area of everything we are coming to do is what I'm going to talk about. So please pay attention. We are going to talk about conditions that should exist for the standard to permit you to classify a non-current asset as held for sale. Because you cannot just get up and classify any asset in your books as held for sale. Before you can classify an asset as held for sale, these conditions must be present. And that is what we are going to look at. So I'm going to look at conditions that will necessitate or will permit an asset to be classified as held for sale. So the conditions that will permit an asset or a non-current asset to be classified as held for sale. And please pay attention to these conditions very well, because all these conditions must exist, or most of them must be satisfied before we can classify an asset as held for sale. So please pay attention. Now, the first condition is that the assets must be available for immediate sale, and that the sale must be highly probable. I repeat, the asset must be available for immediate sale, and that the sale must be highly probable. So it's in two parts. The asset must be available for immediate sale, and the sale must be highly probable. Now, these things you could be asked to provide them in the exam. Okay, that mention the conditions that will permit an asset to be classified as held for sale. And the first one is that before you classify an asset on your financial statement that this non-current asset is held for sale, then that asset must be available for immediate sale. In other words, immediately it's ready for sale. It's not as if, okay, you have a motor van, the engine is faulty. You are planning to fix the engine in the next 3 months before you sell it, or in the next 1 year before let me even say 3 months before you sell it. You have not yet fixed the engine, but you know you have to fix the engine before selling the asset. But you want to classify the asset in your books as held for sale. No, the standard does not permit that, because it will violate this condition. The condition says that the asset must be available for immediate sale. That asset which has a faulty engine is not available for immediate sale. If a buyer should come now, you are not ready to sell it. And because if a buyer should come now, you are not ready to let it go because you have not fixed the engine, it is not available for immediate sale. And therefore, that asset cannot be classified as held for sale. Please pay attention to these conditions, because that is the whole heart of the whole standard that we are doing. Once you understand these conditions, I may or may not even have to go through a lot of questions, because most of the questions that you are going to have is going to require you to advise the company, and your advice will be based on availability or non-availability of these conditions before you can advise that a company should classify an asset as held for sale or not. And so we are saying that the asset must be available for immediate sale. And the second part is that, and the sale must be highly probable. So the probability of selling that asset should be very high. That is what we are trying to say. So as for high probability or low probability, we can say it's relative. Okay, it depends on what you think or I think is high or low. But at least there should be once it's available for immediate sale, then it's likely that there is a high probability of sale. So that is the first condition that will permit you to classify a particular non-current asset in your book as held for sale. Otherwise, you can't do the classification. I'm sure this is very understandable. And then let's look at the second condition. The second condition is that the assets must be currently being marketed at an active price that is reasonable in relation to the fair value. So the asset must be currently being marketed at a price that is reasonable. That is reasonable in relation to its fair value. Now, let me explain this point to you as well. The asset must currently be marketed at a price that is reasonable in relation to its fair value. So let's say we all know that if it is a motor vehicle you are selling, and we all know that if it is, let's say, Toyota Highlander or whatever, and as at now, the value, the market value, the fair value of the asset on the market, we all know is, let's say, 100,000 Ghana cedis. Now, if this is the fair value that we all know, that this asset, sometimes it may not even necessarily be the market value, but looking at the condition of the asset, you have used it, it has depreciated, it is not in so very good condition, or it is in a good condition, whatever condition that you find yourself. If a similar asset on the market is going to sell for 100,000, then it means that the fair value of that asset is 100,000, because the fair value of an asset is the amount at which an asset will be exchanged between two knowledgeable and willing parties in an arm's length transaction. So once the fair value of the asset is 100,000 and you decide to set your price at 200,000, then we are saying that you are not being fair, because your asset value is 100,000, but you are marketing it as a price that is way higher than the fair value. Then you cannot classify the asset as held for sale. So the condition is that the asset must be currently being marketed at a price that is reasonable. So this 200,000 is not reasonable, because the fair value of the asset on the market is 100,000. At least it should be very close to the fair value, reasonably. So that is what we are trying to say, that if it is being marketed as a price that is reasonable in relation to its fair value, then you can classify the asset in your books as held for sale. But if the price at which you are marketing it is unreasonable, you are not permitted to classify. And so when you get a question will give you a long scenario. Inside the scenario, they may give you the fair value of the asset on the market, and then the question will also give you the amount at which the asset is being marketed. If you compare and you realize that the price is not reasonable in relation to the fair value, you advise the company not to classify such assets as held for sale. But if the price is reasonable in relation to the fair value, then you can classify that as held for sale. Okay, so the third condition that must be satisfied is that the sale should be completed or expected to be completed within a year from the date of classification. So the sale should be completed or expected to be completed within a year from the date of classification. Now, this condition is also very interesting. So after you have satisfied the condition that is readily available and that it's being marketed at a price that is reasonable to the fair value, we are also saying that the sale of such an asset that you want to classify as held for sale now, the sale should be completed or expected to be completed within just 1 year from the date of classification. So if you want to classify an asset today in your books as held for sale, and any of the first two is even qualified, but the third point is not satisfied. For example, you are marketing it as a reasonable price, it's ready for sale, but the sale is expected to be completed in 2 or 3 years' time. The standard does not permit you to classify such an asset as held for sale. For you to be able to classify an asset like that as held for sale, the sale should be completed or expected to be completed within a year from the date that you have classified it. That is what it means. So you should also note that condition. And then the final condition that you should also take note of is that the actions required to necessitate such a planned sale will have been made, and it is unlikely that such a plan will be significantly changed or withdrawn. So let me write it down. The actions required to complete the planned sale will have been made, and it is unlikely that the plan will be significantly changed or withdrawn. So that is the final point. The actions required to complete the planned sale would have been made, comma, and it is unlikely that the plan will be significantly changed or withdrawn. So all the actions that are necessary to make the sale, we have started the advertisement, we have maybe announced for auction, something that you see that preparations, actions are being put in place to complete the sale, and it is not likely that we are going to change or withdraw such a planned sale. Then we can classify the asset as held for sale. But if these actions are not in place, or it is likely that it will be withdrawn, it's not certain, then we cannot classify such an asset as held for sale. So these are the conditions that will permit you to classify an asset as held for sale, and you need to master these conditions to be able to give a proper advice to companies as a chartered accountant on how to classify assets as held for sale or not. So that is what you should understand. Okay. Now, having understood this, let me say this before we pick a question. Now, it is possible that the sale cannot be completed within a year. Okay, even though we are saying that the sale should be completed or expected to be completed within 1 year, there are circumstances where actions or events that are beyond the entity's control can delay the sale. Such events could still happen and will still permit the asset to be classified as held for sale. But I'm going to explain that further in the next video. So for now, what I want you to understand is these points that I have brought here. And I'm going to read a short question of advice, and then we are going to analyze and then solve that question, and then see whether that asset will be classified or not. And then maybe we'll bring an end to the part 1 of this video. Okay. So let's solve this question together. Or let's analyze this question. Atakra Limited is committed to a plan to sell a building and has started looking for a buyer for that building. The entity will continue to use the building until another building is completed to house the office staff located in the building. There is no intention to relocate the office staff until the new building is completed. Required. Would the building be classified as held for sale? So let us all analyze this together. It's a very simple question that requires the application of these rules to classify. We are told Atakra Limited is committed to a plan to sell it. Atakra Limited is committed to a plan to sell a building and has started looking for a buyer for that building. So you can see that they are committed to the plan and they have started looking for a buyer. So that is the 4th point. Actions required to complete the sale are in place. Okay, so we continue. The entity will continue to use the building until another building is completed to house the office staff located in the building. This is where the problem comes. You have started looking for a buyer, but the question says they will continue using the building until they have completed another project. So it means that the asset is not available for immediate sale. It violates the first principle, even though the 4th principle is satisfied. But because it violates 1, it cannot be classified as held for sale. Because you have started looking for a buyer, but the building is not immediately available. It means that if a buyer should come now, they are not going to sell the asset. They will tell the buyer to go until they finish the other building, move out their staff. So if you continue reading, we are told that there is no intention to relocate the office staff until the new building is completed. And then required, will the building be classified as held for sale? So such a situation in an exam is not just a yes or no. We all know that for here, we have concluded the answer should be no. it shouldn't be classified as held for sale. But writing that will not give you the full mark, because usually it could be 3, 4, or 5 marks for this simple question. And so telling the examiner it shouldn't be classified as held for sale may just earn you a mark. But you give reasons, because one, you mentioned that even though it satisfies this, then you state the condition. So stating this condition in the exam gives you a mark for that. However, it violates the first one. The asset is not immediate for ready use because they are still occupying it until they complete another one. That gives you some marks as well. So that is what we do. So every question may either go for any or against some of these conditions. So you don't just tell the examiner no, but you state the conditions that it violates and the ones that is satisfied. And that is how you are going to end that full 5 mark or 4 marks that you will see attached to this little question. But I'm sure this understanding is very clear. So in other words, if you don't master these conditions, then I don't think you can give any proper advice on classification of assets as held for sale or otherwise. Now, what we are going to do now is that in our next video, we are going to look at extension beyond 1 year and other circumstances that may distract or extend the period of selling, okay, and whether we should still classify them as held for sale or not when those conditions happen. And then we're also going to look at change of plans, and we are going to solve some more questions that are more practical. This is just an introductory question, but we are using that to end the video on IFRS 5 part 1. Remember to subscribe to this channel if it is your first time. Share this video and let others also have a benefit. Until we meet again for the part 2, it's bye for now. Thank you.